So at the time of doing this presentation, it's May 2017. The information we have is based on this date, so things may have changed by the time you come to actually view this webinar if you're not watching it live. Okay, so with India, there are actually 31 states, and within each of these states, we need to, in effect, calculate the correct GST. So let me use an example. So we have a legal entity or company in India, and that company is in the state of Maharashtra, and it has two other locations or two other sales offices. They're not separate legal entities, they just happen to be offices where they make sales or shipments, and these are in two different states. I'm going to call these ones S1, 2, and 3, so that stands for the state. Okay. Now, if we were to have customers in those states, and we were to make sales within the state for each of those locations, in effect, where we would be charging CGST and SGST. So CGST is your central GST, and then SGST is your state GST. Now, what's really important is that you may have one legal entity, but in this situation, we would actually have to register for 3 different GST numbers in each of the different states. And all sales and purchases that come under each location have to be reported individually. Okay, what about if we were to make sales interstate, i.e. between different states? So in this example, we've got our main entity selling to a different location, and that would be come under IGST, which is your integrated GST. But we also have our Gujarat location, which is selling to a state where we already have a location. Even in this case, we still would charge IGST. The contract of where the ship from or the sale is going from to where it's going to, that is what the GST numbers should be reported. So that's very important to remember. You wouldn't just say, well, actually, because we're selling to a company in Maharashtra, we would actually ship it from Maharashtra. It may actually be coming from a different location where the GST would actually be different. Not the amount, but the actual GST number. Okay, what about if you were to import products into the state? If you were to import products into the state from, say, the United States of America, we would then get an invoice in for, say, $1,000 US. We would have to apply IGST to that particular transaction. And most likely, you would reverse charge that. So if you want to find out about reverse charge, we have details on our website. Okay, so let's have a look at an example. Now, originally, when I was putting the solution together, I would have something similar to this, where we've got 3 different locations, and I thought, okay, on our purchases and our sales, we've got IGST, CGST, and then we've got the 3 different states. And originally I thought, well, IGST and CGST, they're not specific to a state, so therefore the tax is all grouped together and it's available for all. But that's not the case. The legal requirement is that when it comes to submitting your GST returns, the GST returns have to contain the transactions that took place within that state and therefore within that GST number. So in this particular case, we would actually have to have 3 separate locations. So we're taking the information here where we've got three separate states, and then we're putting the information in here. So you've got SGST 1, SGST 2. The CGST and the IGST, even though it's in effect the same tax, it has to be reported under each state or each GST number. And the same goes for your on your sales as well. And so what's important here is that I've split these out by the different states, and each one of these states would have their own GST number. Very, very important. Okay, so how does this work? On your purchases, you're allowed to recover the GST. These become your credits, okay? But bear in mind that these credits, which are also known as a recoverable tax, don't necessarily mean they're going to be 100% recoverable, okay? So you could actually have a situation where the tax is 2,000 rupees, but if you're only 50% recoverable, then only 1,000 of those rupees would actually be able to be recovered, i.e. you'd only have 1,000 credits, or 1,000 worth of credit. So that's very important to recognize. The same would then go true. So once we've allocated our IGST, so we'd take the IGST and allocate it to, first of all, to our IGST sales, then CGST sales, and if there's anything left over to the SGS sales. Once we've allocated all of the IGST credits, we would then allocate all the CGST credits, and then we'd allocate all of the SGST credits. So very, very important there. Okay, so let's have a look at some of the other areas here. So with the IGST credits, and you allocate it to IGST first of all, any amount that's left over would go to CGST. Now, there's a slight spelling mistake there. It should say CGST, not CGT. I haven't invented a new tax. If there's any left over, it would go to SGST, and I've also got the UTGST. So UT, which is your union territories, they are considered the same as states when it comes to actual tax determination and the allocation of the credits. Okay. If there was any IGST left over, then you would be able to look at claiming that back. So, say for example, your total sales was only 1,000 worth of tax, and your total purchases meant you could recover 2,000 worth of tax. Then you may actually have an amount of 1,000 that you could actually credit back from the authorities. Now, from what we understand, you cannot recover that tax back from the authorities. You'd have to wait until the next month. So that's gonna, I'm not sure if that's 100% true, so check with your authorities. But if you are a net exporter, i.e. you buy products locally and then you sell them overseas, this could be a big issue for you. So you may need to get some sort of exemption, or the rules may be different for you. Any GST remaining, as I said, would be covered over the submission period. But what is important is that when it comes to the allocation of CGST, we cannot assign it against any SGST. And likewise, with any SGST, we cannot assign it against any CGST. So that's very, very important. Okay, so let's have a look at an example. Right, so if we take the IGST credit example here, you'll see here that the on the payable side, this is the total of tax that we've paid, and therefore we've got 8,000 worth of credits, and this has been put into our matrix here. You can see on the sales side, we've only got 4,000 worth of credit. So you can actually see that depends. What this actually means is that on the purchasing, we've bought more from out of state, whereas on the sales, we've sold more within the state. So that's a very common scenario. So in this situation, we've got our credits of 8,000, and then the amount of IGST that is due is 4,000. So what we do is we take that amount and we allocate it, or we credit it, and what that actually means is there's a credit balance of 4,000. So according to our logic, the new IGST credit is 4,000. Okay, so we've still got a credit amount. We started with 8,000. We've allocated it to the IGST. We now have 4,000. So we now can allocate this to the CGST. So the CGST amount, as you can see here on the sales, is 10,000. And that amount, as you can see here, is put into the CGST due. And you'll actually see here that if we take the credit balance of 4,000 and we can move that along to the 4,000 in that column, and then the actual balance left over is 6,000. And you can see here that's the 6,000. So that's actually after we've taken the IGST of the original 8,000, we allocated it to the IGST on the sales. That left us with a balance of 4. We then took the 4,000, allocated it to the CGST, which was a balance of 10,000, and that has now left us with 6,000 in balance. Now I've shown you there on against the CGST because that's the actual adjusted balance, and I'll discuss that a little bit more later. After we've done the CGST, of course, we can then allocate to the SGST. Now there's no balance here because the IGST has already been used up, or the credits have been used up. But had there been an increased number of IGST credits, then this would have allowed us to allocate to the SGST as well for that particular state. Okay, so what about now we've allocated all our IGST credits, now we can allocate our CGST credits. So the total amount here from our purchases is 5,000, as you can see. And then the CGST sales is 10,000. But as I said before, don't use that 10,000 amount. We have to take the balance because we've already credited some, remember? So we take that 6,000 and that comes down to our CGST line as the amount that's outstanding. So what we have here then is we have a total of 6,000 that is outstanding still. We have 5,000 credits, which means that when it comes to a payment, we have 1,000 GST balance due. So that means we will owe the authorities 1,000 CGST. Okay. The actual credit, there's no credit balance here. Now, if, for example, the CGST was a much higher amount, then there would be a credit balance, and then that would have actually allowed us to move over to the IGST. And of course, the IGST that is still due is 4,000. So, or sorry, that was the original amount that was 4,000. But if you look to the right of that column, the actual amount after that GST credit had been applied is 0. So there is actually no IGST left over. Okay, finally, SGST. So on the SGST, we have 5,000 credits. And if we look at the sales, there was 10,000. So this is a straightforward situation where we've got, there's no credits haven't been applied to SGST. So we stick with the original 10,000 amount that is due. We can allocate the 5,000 SGST credited. And then we have a balance outstanding is 5,000. So that's the SGST1B. That's the balance outstanding. So that means we owe the authorities 5,000 in terms of GST. Okay, so you can see here that over here the SGST balance has remained the same. And I think it's really important that you put your logic. If you're doing things manually, you put them into a box like this so you can actually track how the credits are being taken care of. So as you can see here, there's the split between what is due and then what has actually been credited and the outstanding balance. So once we've applied the SGST, which we have done, we've applied all the credits. So when it actually comes to applying the IGST, we can still see that there's still a balance of IGST. The amount due was still 4,000. To the column to the right, you can see the amount due, which is 0. And then we take the credit balance from the SGST, which is the S1, which is currently 0, and we move that to the column, which is the IGST credited. Of course, there is none, so therefore we've just got zeros. And as a result, there's nothing actually there. So there is no credits from SGST to be applied to the IGST. Now that can change. And it depends on the number of purchases or sales that you make in the combinations. And these boxes will change accordingly. So if we look down here with the actual tax that is due, you can see there's no IGST due. We've been able to credit all of that off. But there is SGST due, and there is an SGST and a CGST. So they are the amounts of tax that we would have to pay, i.e. 6,000, which is, if you look at the total tax sales and the total tax purchases, there is a difference of 6,000. And this is how it's split up. Why is this important? Okay, so there's a couple of reasons why this is important. The authorities have put this in place for 2 reasons. One is to avoid VAT fraud, and 2 is to make sure that the correct states get the right amount of tax. So you don't just move things around or do things that could potentially cause problems. So here, if we look at this situation again, what we're going to do here is we're going to have an example where we've got S1, which is the headquarters, that's the legal entity, and then S2 and S3 are 2 separate locations, okay? Every single one of those locations has its own GST registration. If S1 incurs a cost of 5,000, and basically what we're saying is that, say we've got an event, and we've got an event in each location, and we incur a cost of 5,000 for each of those events. But the headquarters, the S1, incurs all of those costs, and all the costs are borne locally. And then what we say is those events generate 100,000 each. So S1 generates 100,000, S2 generates 100,000, S3 generates 100,000. So now we have a situation where if we put this into the value here, so this is S1, you can see here that we've got 3 purchases of 5,000. They're all in the single state. So we've got 15,000 for CGST and 15,000 for SGST. And then on the sales side, we've just got a one event and a one taxable sale. Now, what you'll notice down here is that the amount of tax here is out by 10,000. And that's because we had 10,000 tax more in purchases. And that's actually gone to SGST and CGST. So the situation here is that the tax, we have a positive credit amount or negative credit amount, which means that the authorities owe us money for the tax. If we look at S2 and S3, there's no purchases at all, so that's blank, but we do have sales. So each one would have sales of 100,000, and then this shows us that the actual CGST due and the SGST due is 10,000 each, so a total of 20,000. Now I've been basing this on a 20% tax rate, so obviously not the 18 or the 24 or the 5, just to make it easy. It's a 20% tax rate I've been using. So here it's CGST and SGST, it's split 10% each. If we look at that side by side, this is one legal entity. So the legal entity may have made sales and everything would be, seemed legitimate. And, it could have been a situation where the headquarters didn't have locations in the other states, but could have legitimately sold to those states. They would have had a very different scenario. Because all the purchases were made in one state and then the sales were recorded in other states, whilst we have a positive tax amount that we have to send to the authorities, had it all been under one GST number, we would have actually had an amount of 15,000 that we'd have had to have sent to the authorities. In this situation, because we have a credit that's owed to us and we cannot recover this, our actual cost has gone from 15,000 to 25,000. So that's a big impact on your cash flow, and so it makes a big difference in how you set up your locations and how you register the tax, and also how you do deals with the contracts. So the tax would obviously be captured on primarily where you have the contracts with. So you could have a situation where you're going to sell from one state to the same state, so it's an intra sale, and therefore you'd be looking at using CGST and SGST, but at the time the shipment is made, you have to ship it from a different location, from a different state, and then that would come in with an IGST. So there are different situations here where the tax can actually have a big impact on how you run it. So that's something you have to give thought. Now, before I finish on this particular recovery rate, there's a massive risk. This is a time bomb that I don't think many people are going to realize, and it's going to cause a lot of issues, in my opinion. So here's our supplier. The supplier sends us an invoice for 118,000, so it's 100,000 tax. I've used an 18% tax rate in this time. We have the tax amount, and then we have the customer, which is us. And so the invoice that comes in is 118,000, so it's exactly the same. We would expect the supplier to have submitted their tax returns, and they would say, well, we've charged this company 118,000, and therefore the amount of tax was 18. They've paid us, so there's the tax. And then, of course, we say, right, well, we paid this amount. We want to recover it. We've got those as tax credits. We want to recover that amount. Thank you very much. And then the loop is complete, okay? This is the cascading effect of tax. The supplier charges you, you recover it, you pass it on, and it keeps going on until it hits the end vendor. But what happens if your supplier does not submit their tax returns on time? And bearing in mind this is a new tax solution, and depending on the type of vendors, things can get a little bit messy. But what happens if they don't submit the tax return in time? Okay, this is a big thing. So feel free, if you're watching this on the recording, feel free to pause this and have a look. This is the legal jargon, but technically this is what's happening. If your supplier fails to submit their the 100 or the 18,000 tax in their returns, and they sent a warning to say that that there's a discrepancy here, and they do not get that populated in time or do not update it in time for whatever reason. Maybe they've had a failure in their system, they've lost the invoices, maybe they've they've just got a strike going, or whatever the reason, they just can't cope and they have not submitted their returns and they will not. What it means is that you can't recover that tax. So you may be expecting your cash flow to be, we're paying tax of, say, 100 grand, when in actual fact now you're going to have to make an adjustment to your own system, and your cash flow, you're going to have to pay tax of 118,000, because that tax that you thought you were going to recover is now offset, and you can no longer recover it. You actually have to basically pay it, or rather you can't use it as an offset. So this is going to be something where I see a lot of mess, a lot of companies missing out on tax, and potentially companies facing financial difficulty. All they need is one big vendor who they're recovering the tax from not to submit their tax returns on time, and you would be, from a cash point of view, you wouldn't be able to recover that tax even though you may have paid it, and that could be a cash flow issue that would cause a lot of problems. So expect to see legislation changes around this, or rather, things. I think there'll be some entrepreneurial ways around this. Maybe there'll be some legal insurance, or maybe look at factoring, where you may have to pay a 2%. Or whatever it is on the financing, but at least you get your invoices paid, and then it'll be up to the factoring company to sort things out afterwards. Of course, if you make mistakes, everything's going to be rejected. The idea is that there's a triangulation, so that all of the submissions are matched off. I really can't see this working too great. From what I've seen so far, I'm sure there's going to be lots of issues around this. So maybe what they'll do is allow people to recover tax regardless initially, but when everything is up and running, you need to make sure that your vendors are submitting their tax returns. This really highlights the importance of having proper tax automation in place with proper tax compliance, the type of solutions that we at Innovate Tax deliver all the time. Don't go with your have a go hero, someone who's just setting up the tax for the first time, because you're going to be one of those companies that are going to lose out financially. So you have been warned. Make sure you do this correctly.